Hello, Pete. How are you today?
Hey, John, how's it going?
It's going great. Hello, everyone. I have something absolutely amazing I would love to share with you today. In this video, I'm going to share with you today the method I use for trading options consistently, just like the large hedge funds and institutions. I'm going to show you my simple to follow 5-step process for grading the market every week, analyzing the different groups and sectors, building the right watch list at the right time, and analyzing the correct strategies, and finally implementing those strategies into actionable trades at the very end. So my name is John Napolitano, and I am a professional trader for over 25 years. During this time, I've worked for large institutions and trading desks, trading millions of dollars of firm capital, where I've mastered the skills necessary to trade options effectively. Now I'm a portfolio manager who trades his own capital and has coached hundreds of people on how to navigate the markets correctly. Today, I will do the same thing for all of you. Are you currently trading options and find yourselves just so close to profitability, but you just haven't quite gotten there yet? I know I've been there, and I know Peter has been there too. If you don't have to be glued to your screen 24/7, you don't have the time, or you have a small account size, but you're curious about trading options and think it could help you generate an additional revenue stream, and for all these reasons, this is the right video for you guys to watch and what I'm going to share with you this evening. So thanks for your time, and let's jump right into it if you don't mind. Are you all ready, Pete? You're all set?
Yeah, I'm excited. I think one of the biggest things tonight, John, we just want to really stress from the beginning is that most traders, whether options or stocks, but especially options because there's the time factor and all those other things, most people live and breathe and die on that one trade working out. And tonight we're going to completely flip that on its head to the point where what you say all the time is one trade shouldn't matter. And I think that's the big thing for tonight.
Yeah, absolutely. So, a typical new trader will focus on so much research. They'll focus on like studying specific stocks and trying to come up with the most optimal idea. And that's usually, unfortunately, a recipe for failure over time. So we're going to definitely kind of dissect that a little bit today. So we're going to jump right into it right now. I'm going to share my screen with you guys. Let's see here. So you can see that, Pete, okay?
Perfect.
All right, excellent. So basically, what we're going to do is talk about building an optimal option basket, how to trade like an institution so you could control risk, increase consistency, and reduce stress. If you think about it, large institutions don't trade one or two stocks or options, and neither should you. So we have a strategy that basically follows what they do, and we're going to jump into it right now. So before we do, actually, we obviously have to talk a little bit about a quick disclaimer. Obviously, the authors are not, of this training program. We're not registered investment advisors. We're not here to give advice. Obviously, you have to run everything through your own trading plan. We don't make any recommendations whatsoever of buying or selling stocks or other instruments. All information and material provided therein are for informational purposes only. Any information contained in the commentary, reports, or opinions published by the author should be independently verified, are urged to consult with their own financial advisor. So obviously this disclaimer is very important. We all have to take responsibility for our own actions, both in life as well as in our own investments. So without further ado, I'm going to jump into it now. So just a little quick background about myself. Obviously, I talked a little bit about it earlier. I have an institutional trading background. I'm currently a portfolio manager. I am a native of New York City, just like Pete. So we have our New York City accent still, even though we're Florida natives now. I graduated from Fordham University back in 1996, which I actually thought was a really cool time to graduate college because that was right during the dot-com bubble. You know what I mean? That's when I first started trading stocks and I first started getting interested in the stock market. I began my career at a global asset manager for a prestigious French bank, first in operations and accounting, and I eventually worked my way onto the trading desk where I earned my master's degree in finance. Within about a 10-year period, I became the head trader of this large fund, and I basically me and my team, we managed well over $40 billion at that point of other people's money. So that's really where I got this whole institutional concept where it began and where I started developing it. And that's where I first kind of fell in love with options, particularly in 2008 during the crash. And during the financial crisis, it obviously helped us manage our portfolios effectively through obviously going against the market and also hedging the positions that we had. So that's kind of where I fell in love with options and the whole institutional concept and the whole basket concept, where it's not all about one stock or two stocks. It's about putting together an optimal basket at the right time. So currently, like I said, I've been coaching this stuff and I've been trading options actively for well over 25 years at this point. So this 5-step process is what I developed over time, and a lot of what I'm going to share with you guys tonight is not something I invented by myself. It's just something that I've tweaked, and I've developed a step-by-step process that is really easy to follow. So step number 1 is grading the overall market. The market actually has a great deal to do with how your stock is going to perform on a week-to-week basis. If the market, for instance, is really strong and then all of a sudden, for whatever reason, it crashes or there's a corrective action during the week, obviously, whatever stock you pick is probably going to go down. And that's kind of where the 60-20-20 concept comes from. And we're going to get into that right now. So what's so important about grading the market anyway? Well, what you essentially want to do is you want to match your basket or the group of options that you're going to be trading at the same time, essentially with what the market is giving you. So it maximizes profit potential by ensuring your trading strategy matches market conditions. So you're not just making stuff up. You're not super bullish when the market is giving you bearish or vice versa. You're essentially matching your own optimal basket and what you're trading with what the market is giving you. And if you think about it, it kind of makes sense. It's fairly logical, but this is a major step that a lot of new traders just ignore. They do not pay attention to what the market is telling them versus what they're actually trying to trade. So it avoids market conflict. It preserves capital by preserving losses from fighting market trends. So one of the things that I love to talk about is if you're in a sailboat and you have 3 sails, let's say you're in the middle of the ocean and you have one really big sail and 2 little sails. And that big sail is basically the stock market. If the stock market is not giving you any wind on a particular week, you should not be allocating your full resources that week. You should be a little more conservative, not only with your trading, but with your position size. And that's what the professional traders are really good at. They know when to step on the gas and they know when to ease up on the gas. And that is what we have to do in our own portfolios as well. I hope this is making sense for all you guys so far, but that is basically what it's all about. So grading the market, the 60-20-20 rule improves trade selection by recognizing market impact on individual stocks. So the market itself impacts whatever stock you might be picking at that time. This understanding helps traders avoid overconfidence in stock-specific analysis and better their entries and exits based on broader market conditions. So strategy adaptation, it enhances long-term survival by developing a flexible, reality-based approach. So you're not trading what you're hoping and what you're dreaming. You're trading what the market is giving you week after week by going through this grading process. Grading the market is the super most important first step that you're going to do in this process. So grading the market, what does that exactly mean? Well, I've pretty much kept it super simple. I love keeping things simple and manageable and something that you can follow on a week-to-week basis. So obviously, what you essentially want to do is grade the market. You can grade the market any way you want, on a scale of 1 to 10 or 1 to 5, whatever you might want to do. But I generally do D to D minus on the bad side and A to A plus on the good side to assess overall market conditions. So this grade serves as the primary basis for constructing a basket and determines the level of risk exposure appropriate. So basically, if it's an A plus market, you're going to be more aggressive. If it's a D market, obviously, you're not going to have very bullish ideas that particular week. So I hope that makes sense to everybody so far. The 60-20-20 rule, individual stocks don't exist in isolation. I want everybody who's listening to write that down. Your stock is not in a vacuum. It's not in a bubble. No matter how good of an idea you have, if the market decides to go against you, chances are your stock is going to go down that day too, or that week even. So approximately 60% of any stock's movement is directly influenced by the broader market's performance. The fundamental concept explains why stock-specific research alone is insufficient. So research is important. Obviously, picking the right stocks is important. We're going to get into that later. But in the very, very beginning, you have to understand market direction, grading the market based on sentiment, and what is the market trying to tell you. So obviously, here's a perfect example of a corrective action when you have a massive sell-off in the stock market. This is a heat map of the S&P 500. And for all of you who can see this, every single stock in that heat map is pretty much down. I don't know what kind of day that was, but basically it was a pretty ugly day for whatever reason. It affected every sector, every stock, and every group. And you could clearly see that. So all that research that you spent all week doing obviously went down the tubes because your big sale is obviously going in the wrong direction. So that is something you have to be very acutely aware of when you're trying to put together your optimal options basket. So grading the market, the construction strategy, basically, here's a good example. So a typical grade might be BB minus. So if you think about it, if you grade the markets and you grade the trend and you look at the overall condition of the market and the market sentiment and what's going on, and you compare it to the prior week, and let's say you decide to give the grade of a BB minus. We do this in our newsletter. We do this in our coaching, obviously. But let's say you come up with a grade of BB minus. That suggests a pretty bullish approach, but it also means you should have some bears in your optimal basket too. I keep using this word basket as an analogy because what you're essentially doing is you're not trading one or two things. What you're essentially going to be doing is be putting together an optimal basket of maybe 10 or so names at the same time. The options market allows you to do that with a small account size and as efficiently as possible. So with a B minus grade or a B plus grade, you're looking at about 4 to 6 bullish names that you're going to be going through the process with. You're going to maybe even have 1 or 2 neutral or non-directional trades, which we also go over in our coaching. And we also have 4 to 5 bearish trades. So in a theoretical basket of 10 names, you're going to be maybe 60-40 or 50-50 or something like that. But you're sure as heck not going to be 90% bullish in a B minus market. So I hope that makes sense to everybody. So, feel free to type in the chat if you understand where I'm coming from, if this makes any kind of sense to you guys. But basically what we're doing is essentially we're following the market.
John, one question we got before is if somebody's swing trading, how often do you regrade?
That's a great question. I grade the markets on a weekly basis. I go through the whole process, and then midweek, I'll do a little bit of an adjustment, or I'll do, I kind of look at the markets every day, but I generally don't make a major adjustment unless there's like a major change. And that would be a trend break. That would be a break of a moving average. That would be a major shift from like one group to another or from one market to another. So for the most part, the main analysis is really only done about once a week with maybe some small tweaks intra-week, let's call it, if you're a swing trader, okay? So as far as time constraints go, this is not a very time-intensive process. It may sound like a lot, but it really is, you're just looking at a couple of charts to grade the market at this point, okay? Risk management, so the market grade influence not just talks about direction, but it also gives you overall risk exposure. So obviously an A plus market, you would put on more risk, or a B minus market, you would put on less risk. You still might be a little bit bullish, but for the most part, you're not going to be stepping on the gas because the overall market is not giving you what you want. Instead of being hopeful and praying that your stocks might be working, you're essentially letting the market dictate to you what to do. Okay. So this is an institutional trading edge. Professional traders and fund managers maintain their advantage over retail investors primarily through their comprehensive understanding of market-wide analysis rather than solely focusing on 1 or 2 stocks. And I see this happen all the time. I get questions all the time, Pete, and I'm sure you do too. Hey, what do you think of this stock? What do you think of that stock? I don't think, period. I look at the I look at the charts, and I let the markets tell me where I should be trading and what group I should be looking at. I don't have any particular favorites, and I don't trade the same stuff every week. So this is an adaptive trading strategy. Success in trading requires aligning strategies with current market conditions rather than personal biases or wishful thinking. This adaptive approach ensures trading decisions are based on market reality rather than predetermined preferences. So,
John, before we move on, we got one question here about account size. And I know this is something that comes up actually often.
absolutely.
People hear the word portfolio and think that they need to have $1 million account. But that's not true with options,
Absolutely not.
right?
So, I mean, you could put together an optimal basket probably for well under $10,000. I would say, you know, a 10 stock portfolio in the options market can be done fairly, fairly easily with a small account size. So 25,000 is more than enough. 25,000 does give you the ability to implement some leverage and to use a margin account, which is obviously, you know, a favorable circumstance. But if you have a smaller account size, you could totally implement this strategy. Okay.
We always want to make sure that as we finish each step here, we just want to summarize it. So before we hop into number two, how would you summarize number one so people can just take away that one part?
Yeah. So step one, the takeaway is you're grading the overall market. You're assessing what the sentiment of the market is compared to the week before. You're looking at trend and you're looking to see which part of the market is the most strong. So is the NASDAQ stronger? Is the S&P stronger? Is the Russell 2000 or the Dow stronger? Or are they all strong? Sometimes that gives you your first clue as to where you should be looking. For instance, with the Magnificent Seven, if the NASDAQ is really strong, obviously you're going to start focusing on some tech names. If the NASDAQ rolled over, but the S&P happened to be really strong, you might want to lighten up on tech names and start looking at other groups, which we're going to get into next. But basically, grading the market gives you that first step. It gives you that ability to put your basket together, because right now you're saying to yourself, okay, well, I'm not going to be too bullish, or I'm going to be very bullish, or maybe I'll be somewhere in between, because essentially what you're doing is you're saying, what is the market giving me? Now, if the market is giving you all red, like I showed you that heat map before, if it looks, you know, if it looks up and like this, you know, then guess what? You're going to be the other way around. You're going to be maybe being 80% bearish, you know what I mean? And maybe only 20% bullish. So that's essentially what the first step is all about. Assessing what the market is giving you so you could determine what your basket is going to look like for the week ahead.
John, what are your thoughts on this? I'm not entirely sure that's true that you can't trade options with less than 25,000.
That's not true. You could buy straight calls and straight puts. I think there's a lot of smaller accounts that you can do that. It depends on the broker. I don't think that's necessarily the case.
I think the brokers are really more concerned with when you open the account and they give you the questionnaire for what is your experience, and then they kind of open up options, no pun intended, for you to do different types of options.
Yeah, I think so. To round out that question, I think if you have a larger account, you're able to do multiple strategies. So you might have less. You might just have less for a smaller account size. You might be able to just do less strategies, and that's what it comes down to: managing risk. So I'm going to move on to step two. Grading the sector is really the first 20% of that 60-20-20 rule. So again, it's all about sectors as well. After you've determined what your market grade should be, the next thing you're going to do is drill down a little bit deeper. And you're going to start looking at the 11 different sectors that are in the markets. You're going to capitalize on institutional money flow by positioning ahead of major sector moves. It improves timing of entries and exits. When I was an institutional trader, it would take me sometimes weeks to accumulate positions that my bosses wanted me to accumulate. I'm going to repeat that. It took weeks. So if my boss said, hey, listen, we really like energy, we're going to jump into the energy sector, it might take me weeks to accumulate the millions of shares that it took to build positions for those size of funds. So sector rotation is real, and it usually lasts for several weeks. And you have to be able to capitalize on that when you see it happening in real time. So that's why sector analysis is step two. It is the second part of this process, where you're looking at the market, you're grading the overall market, and then within each individual sector, you're going to be grading those sectors too. Because one sector is obviously probably going to outperform another at some time or another, and you have to be aware of when that's happening. So it spots early warning signs of market shifts and also helps you manage risk to get out of certain groups when they're starting to get out of favor. It creates systematic approach to sector selection, removing emotional bias. So again, it removes your favorites, right? Everybody has their favorites or stocks that they love to follow. This completely eliminates that. You're essentially picking the groups that are making the most sense at the time. So again, you're letting the markets tell you what to do instead of you attempting to tell the market what you want to do. It's kind of intuitive if you think about it, but most new traders don't think about things this way. They try to pick individual stocks. So performance analysis action, it efficiently identifies the strongest trends to trade with and the weakest to trade against. So again, you're going to be going long and short at the same time. You're going to be buying calls or call strategies, and you're going to be buying put or put strategies within your basket. So you're going to have maybe some bulls and you're going to have some bears at the same time. So you have to select which sector to find your bulls and which sector to potentially find your bears. And that's what sector grade analysis does. It narrows your focus to the highest probability opportunities, and it prevents wasted time. It ensures portfolio aligns with current market conditions, optimizes risk reward, and matches direction with sector strength. It keeps portfolio current with market trends as well. It prevents holding positions from deteriorating. So again, you're following what the sectors are telling you to follow. So what's so important about grading this stuff? It concentrates trading in the strongest areas. So you want to find the best of the best. And if you want to go bearish, you want to find obviously the worst of the worst. And you want to put that all together in a basket every single week. And by doing that, you're going to find the best stocks and the best sectors, and you're going to be great in the market and figuring out what percentage you should be bullish and what percentage you should be bearish. You're simply following what the markets are giving you.
John, what's your thought process if you have a neutral market but stronger sectors? How does that affect your thought process for position sizing?
Yeah, so there's always going to be bullish exposure. So let's say the market is giving you a more neutral stance, where let's say the market's not making new highs like it is recently, actually, right? We made a new high, but we're kind of just in a range or what have you. So I'm going to have some non-directional trades, but I'm going to pick some non-directional sectors. So within the market, there'll be sectors that are non-directional that match what the S&P 500 is doing as well. I'm going to be looking for non-directional trades in those groups. Now, there might be one or two outperforming sectors within the group. So what I'll essentially do, Pete, is I'll put up a chart of the S&P 500, and I'll put up a chart right alongside of it of the sector, let's say XLE, which is energy, for instance, or what have you. And I'll say, well, that one's outperforming. So that's where I'm going to look for my 2 or 3 bulls that I'm going to be adding to my portfolio this week. So that's essentially how I figure it out. I hope that makes sense. Because again, I'm basically just matching what the market is telling me. I'm doing it very methodically, and I'm doing it differently every single week. I'm following the same process, but obviously the sectors and the names are going to change every single week. So it's not a lot of work. It's just a matter of having a process in place that you can diligently follow on a week-to-week basis.
I think something that's very different about this, John, that I want to make sure everybody grasps the point, is most people predict or try and forecast what's going to happen next. What we're talking about here is allocating money to what's already going on and then having a system for telling us if it changes, which is a lot less stressful.
Absolutely. So you place your trades based on what the market is giving you, and then obviously you're going to be making adjustments throughout the week. So most of your week is going to be spent just kind of watching to see if there's any major changes going on in the sectors and in the particular market. And then obviously you'll have stops and risk management in place on your individual trades. So when you pull that all together, the process really makes sense, and it's something that's very easy to follow. Okay, so it aligns trades with large institutional capital movement, benefiting from sustained sector trends rather than fighting them. So I've seen this a million times. You find, let's say, a really good stock idea that you like because you happen to be biased and you love this name and you follow it, and Jim Cramer says it's a great name, and so on and so forth, whatever it might tell you. But essentially, the sector might be in the doghouse. It might be in a downtrend, and maybe even the market isn't behaving that well. So maybe it's not a good idea at that moment. So I want you to just think about that 60-20-20 rule whenever you are deciding to place an order on something. Are all those things in your favor? Are all those sales have wind in them? In other words, are they blowing in the right direction? That's essentially what you're going to be doing. So you look at the ETF market. The sector ETFs are very easy to follow. There's 11 of them. We in our newsletter we list them every single week. So there's XLE, XLF, XLC. I'm not going to go through all of them, but there's 11 of them, and we go through that grading process for you. Well, we obviously from a week-to-week basis we grade them, and we compare them to the overall market and decide which ones have relative strength and which ones have relative weakness. So this signals institutional money movement and potential trading opportunity. So we compare it to the performance of the S&P in order to find the best of the best, because if you have the S&P up here and you have another sector next to it, and one sector is breaking out to all-time highs and the S&P has been range bound, obviously that is an outperforming sector, and that gives you your first clue into step 3, where you're going to start looking for potential opportunities. And that's pretty much how the process works in step 2. You're essentially looking for the right neighborhoods to look in. So think in terms of the sectors as different neighborhoods you're going to be looking in. You want the best of the best when you want to go long, and obviously you want the worst of the worst when you're looking to potentially go against the market or go short.
John, I think a point that we want to make super clear here, we don't want to take for granted. We haven't even talked about what individual positions. We're basically creating a foundation behind an idea, which is going to set trade expectation and risk and conviction and all that before we even look for an idea.
100%, Pete. So, I haven't even gotten to stock selection yet. You know what I mean? Like I've put in a little bit of work at this point. I've graded the market. I've decided how bullish my basket should be, how bearish my basket should be. How much risk am I going to put on based on what the market is telling me? And then essentially I'm going to look at the individual sectors and say, well, I like energy this week because it outperformed the S&P. I like technology this week because it outperformed the S&P. So out of a universe of 10,000 possibilities, maybe energy has 500 names. Maybe technology has another 500 names. I just kind of lowered my bullish choices down by several percent. You know what I mean? And that's essentially what I'm doing. I'm kind of narrowing that funnel step by step. And we're going to continue to narrow that funnel where you're going to have a very small watch list at the end of the week. You know what I mean? And that's really what we're trying to get down to here. So as you can see by this heat map that I have up on the screen right now, this is what a typical sector rotation looks like. And you can see it's pretty profound. And this could happen from week to week. If you look at the chart on the upper left-hand side, you can see the heat map has all the big tech names and all the Magnificent Seven and Google and Amazon. They're all up substantially. And everything else looks like a little bit of a mixed bag. And then sure enough, if you look to the heat map on the lower right-hand side, you can see that it completely did a little bit of a 360. So what is good one week might not be good another week. And this is what I mean by institutional rotation. Institutions, when they decide to sell, they'll just dump something and they'll stay on it for several weeks because they're moving their capital to other parts of the market. So if you don't jump on that train, you're going to get run over essentially because you're going to be still in Microsoft and Google and Amazon when the market basically abandoned them. And that's essentially what happened. If you look at that heat map, they went out of those main tech names and they went into, you could see what they went to financials. You can see JP Morgan, you can see Bank of America on the lower left-hand side. You can see Tesla was red the week before and then it was green on the bottom. So this is just an example of how sectors often rotate. And if you're not paying attention, if you're just paying attention to the market, let's say, and you're not doing step 2, you're going to miss this. You're going to be in the same names over and over again, and you're not essentially going to catch when something starts to move in the direction that is going against you. So that's why step 2 is so important. You want to see when the sectors are favorable and when they're not favorable. Hope everybody gets that so far. I hope that makes sense to all of you. Let me know in the comments if that's a yes, if you understand where I'm coming from, because sector rotation is real and it happens, it can happen within a couple of weeks and it could continue for quite some time. Because again, institutions tend to hold things for a long time. They tend to trade things for weeks at a time. So this could last for a while. It could be headline driven. I don't know why it happened, but it could simply happen for whatever reason. They just decide to dump a certain group and move money into another group, and that happens all the time.
John, do you, just as an aside, do you have any recollection of what was the biggest position you ever built?
Oh wow! I mean, I used to do $200 million tickets on some of these larger tech names,
Wow.
and those would just as a for a $40 billion fund, if you think about it, 1% of 40 billion is 400 million.
Wow.
So if I'm building just a 1% position, I have to do a $400 million ticket. So I'm not going to do a $400 million ticket in one day. I'm going to do a $400 million ticket over several weeks because I don't want to take the risk of jumping in at one price. You know what I mean? Even if I'm lucky enough to find the liquidity, I'm not going to jump in at one price and run the risk of it going down 5% in my face when I'm trying to build a position. So that's really the reality of institutional trading. And with that background, that's kind of how I developed this process. It just makes sense. It's kind of clear to me. I know it's sometimes challenging for newer traders to kind of get their head around the whole big picture. You're essentially putting a big puzzle together every single week, and it's not hard because the process doesn't change. I'm going to say that over and over again. Once you get the hang of grading the markets, looking at the sectors, putting grades on the sectors, and then figuring out where to look, it just becomes a step-by-step process, So I apply the same gradings to the sectors as you can see here. I essentially do the same exact thing. I place, anywhere from a scale of A to D. I track the changes from week to week. And then I just spend 5 minutes comparing each ETF to the S&P. So again, I have a chart of the S&P right here, and I have a chart of whatever sector I'm looking at right here. And I say, hey, which chart looks better? Does this chart look better than that chart? And if the sector I'm looking at happens to be better looking, meaning, obviously a better uptrend, the moving averages are sloped up, better volume, obviously the typical criteria that you would use, I would say, hey, I'm going to add this sector to my basket. I'm going to look for stocks in that sector to add to my optimal basket for the week. Same thing on the downside, by the way, if I'm going short, same concept, only in the other direction. So after identifying strong and weak sectors, I focus now to stock screening, only with those sectors in mind. So you could use, there's many different stock screeners to use. I love using FinViz. I know, Pete, you're a fan as well. It's pretty effective, and it's free, actually, for those of you who want to give it a try. It's a real good way to kind of filter down the different sectors and the different groups. So here's a classic example of what I'm talking about. If you look at the chart on the left-hand side, you can see that's the S&P 500. And you can look on your right-hand side and you can see the energy sector, which is XLE. So this is a little bit of a dated chart, but you can see here that the S&P is kind of choppy. You can see the moving averages kind of crisscross. You can kind of see it hasn't made new highs and so on and so forth. Now, the XLE had a really nasty sell-off, you can see, back in December, but it bounced really, really significantly where you have all the moving averages moving upwards. You now have this big movement to the upside. So when you see a big move like that off the low, and it continues to break moving averages and make the slopes go back up, you better start looking in that sector for certain ideas. So that's pretty much what I do every single week. I'll compare each sector to the S&P and say which one simply looks better. So a typical grade, if you look at the S&P, it hasn't made new highs. The moving averages are crisscrossed. So I would probably give a market like that, I would give it maybe a B minus to a chart that looks like that, but maybe a B plus to a chart that looks like the one on the right hand side, because I wouldn't give it an A because it hasn't made a new high and it hasn't really pulled back yet and formed a valid trend. It just kind of bounced basically, but it bounced pretty darn hard, enough for me to give it a B plus at least. So that means that I'm going to start looking for energy ideas. If that was the case, this chart's a little dated, like I said. So again, this is not advice. I just want to give that disclaimer again. I'm just showing you an example of kind of the stuff that I look at. So once you do the sector implementation, strong sectors get bullish positions and weak sectors get bearish ones. And I adjust position size based on overall strength. So if the market's giving me an A plus, I want to have really bullish ideas. If the market's only giving me a B plus, I might have a 60-40 portfolio or a 60-40 option basket, but I might not be fully stepped on the gas. In other words, I'm not going to be completely committed with all my capital when the market's not giving me what I want. So, you got to, as a professional trader, you got to know when to step on that gas and when to kind of ease off and wait and see what happens. So adaption action, you're going to review sector leadership changes weekly. It doesn't change that much, by the way. Usually sector rotation, it's usually a weekly thing. There might be a massive change in the middle of the week, but that's usually fairly rare. Trends tend to continue for a pretty long period of time, at least usually a couple of weeks. So you're going to exit positions in sectors showing grade deterioration and enter new ones in sectors with improving grades. So if one sector shows some leadership in the following week, you're going to start reducing positions in maybe an underperforming group that maybe isn't, here's where maybe you're not getting stopped out or you didn't take a maximum loss on a trade, but maybe a stock just isn't performing the way you want it to. Why keep that around? If your edge is gone because the sector is starting to deteriorate, then you should probably reduce or eliminate that position to make room for something new, because we all do have limited amounts of capital. You don't want to just sit in something just because you picked it 2 weeks ago. So, give me a shout if that makes sense to you guys, because what you're essentially doing is you're always thinking in terms of optimizing your basket. That's what it comes down to. Basket optimization. You're saying, okay, this sector changed. Now I need to move from here to here. I'm going to keep some of my stuff on, but now I'm going to make a little bit of room for industrials or for energy or for whatever it might be where it's starting to outperform. Okay. So that's really where the adaptation comes in. And this is what hedge funds do really, really well. They look at the overall markets and sectors and said, okay, I'm going to start moving into this group, or I'm going to start moving into that group. And we're simply just matching what they're doing. That's all we're essentially doing. Finally, now this is step 3, but the last step in the pyramid process here, where you're looking at the stock, the sector, and the market, the sector, and the stock, the last 20% has to do with stock selection. So stock selection does matter, guys. It's not like, doing a little bit of research doesn't matter, but we're going to do research in a way that you might not realize. We don't necessarily do fundamental research where we're trying to pick the lowest PE ratio or something like that. What we're essentially going to do is find the outperforming names within the sector that we choose. So now we're down to the stock selection. We're going to remove stocks with poor liquidity. Now, so in option land, this is really, really important, because stocks that have poor liquidity and high transaction costs, you want to eliminate, because obviously options have strike prices and they have bids and offers. And sometimes those bids and offers, when you're trading options, can be really wide. And they're usually really wide when a stock doesn't trade well. So when we do our filtering, we essentially eliminate poor liquidity, high cost, insufficient option strikes. It prevents trading in instruments that could lead to execution problems or strategy limitations, because we do multiple strategies here. We don't just do puts and calls. That's the last thing we'll talk about a little bit later. But one of the most important things that new traders miss too is they pick the wrong strategy. So we have to pick things that allow us to maximize the ability to pick what strategies we want. So movement range, it identifies stocks with inadequate volatility, price movement. It generates profitable opportunities. So eliminates low movement stocks. So we want things with adequate volatility and price movement. Trend alignment. We focus on stocks showing the strongest directional movement that matches the market analysis. So it improves probability of success by trading pronounced trends. So we are looking for the best of the best. We eliminate all the garbage, all the stuff that doesn't trade well, all the stuff that's not trending, all the stuff that has lousy volume, all the stuff that has low volatility. That all disappears. And in that universe of 10,000 different names, you're going down to the different sectors, and now you have a couple of hundred to choose from. Now you're down to like 30, essentially, is what you're doing. You're going down the ladder, and you're making that funnel smaller and smaller every single week.
John, what would you consider poor liquidity?
On a stock or on an option, Pete?
Well, both, I guess.
Okay, so on a stock, poor liquidity has to do, I would say, under 500,000 to 1 million shares is ideal, or more. You know what I mean? Also, I like things that have a high price tag. I don't want anything under $20 or $30. I like to pick things over $40 because that allows me to have more strike prices. It allows more flexibility. Institutions don't like trading penny stocks. So forget about penny stocks. Institutions don't get involved usually with something that trades under $20. And the reason why is because think about how many shares they'd have to buy. They'd have to buy 10% of the company. in order to have a position. So when Vanguard and State Street and BlackRock go to buy something, they don't care about a $20 stock. They're going to load up on the big stuff and the liquid stuff that they can easily trade, easily get in, and easily get out of. So this allows for emotional control too. It removes personal bias and emotional decision making. So if you think about that, by filtering things based on liquidity and by appropriateness, you essentially eliminate some of your favorites. You might eliminate ones that maybe, that someone told you to trade, or something that maybe popped up on a report that you saw. It just takes away all that bias. You're just mechanically going through the market sector, and then you're going to begin your filtering process on step 3, where you're going to eliminate illiquid things. And so to answer your question on the option side, Pete, illiquid options would basically be things that have very low open interest, very few contracts traded. They only offer, let's say, monthly expirations instead of weekly expirations. That's another big one. Some stocks only offer monthlies. And if you're going to go ahead and buy something like that, you need to make sure that it at least trades well. You know what I mean? I generally don't like anything that has more than a 10 or 15% spread between the bid and the offer. That's another criteria that I like to look at. Spread between the bid and the offer matters more with options than obviously with a stock. So those are kind of criteria that I look for as well. And that's all in we talk a lot about that in the newsletter. I mention this all the time in our game plan meetings. These are the things we have to kind of drill down to in order to find the best ideas. So stock selection, you're going to apply technical and volume filters to identify those optimal situations. This systematic approach eliminates unsuitable names. The liquidity screen, we have 1 million shares a day here as an example. That's a pretty good metric to use. If let's say you underfilter and you only get a couple of names, you could go to 750 or 500,000. You can move down the row a little bit. None of this stuff is necessarily written in stone, but these are guidelines to use to help you find the best ideas. You know what I mean? So, certain sectors, certain groups might be a little challenged, like basic materials. They don't always have, these massive names that trade so well. So you might need to tweak things a little bit here and there, but you'll get the hang of it the more you practice. ATR and beta above 1 is something I do like to stick to, though, because stocks with insufficient volatility for option strategies, these metrics help select stocks with appropriate movement for profitable trades. So beta is basically volatility. The stock market has a beta of 1. So essentially, you want something that has the same volatility as the stock market or higher. So a beta of 1 or higher will give you that volatility that you need to make money in the options market. An ATR of 1 basically says that your range is at least $1 a day. So obviously, you want something that trades, that goes in one direction or another, at least $1, because otherwise you're not making any money. It's just a boring stock. You might be trading something that just doesn't trade very well, or is kind of stagnant or sideways. So that kind of eliminates all that stuff. And then when you get down to it, you're going to focus on key moving averages. You're going to be focused on key moving averages to detect trend, to make sure the trend is strong and upward sloping or downward sloping if you want to go in the opposite direction. And you're going to generally stick to a price level of $30 or $40. This will ensure adequate option strike selection and institutional participation, like I mentioned earlier. So you're going to wait for technical setups now for your entry. So now that you've put your watch list together, you're going to set alerts for when, let's say, there's a bull pullback or a bear rally. We talk about that as well. You're going to try to pick optimal entry points like basing or something like that, where you have a situation where the stock took a little bit of a break or it pulled back, but it's still in that uptrend. This patience improves entry prices and initial trade structure. You're going to have a dynamic watch list management. So this watch list we're going to put together every single week. We're essentially there will be some names that kind of repeat themselves on a week-to-week basis, especially since certain sectors tend to trend and so on and so forth. So you might have some repeats from week to week, but you're always going to have a couple new ones here and there to take a look at. And then some things will obviously fall off once sector rotation happens or once the overall market decides to go in a different direction. So your basket size management, here's where it comes down to. Now that you've decided what your optimal basket should look like, you're going to add new positions based on available risk capacity and your market grade. This prevents overexposure. So again, if the market is only giving you a B or a B minus, you shouldn't be stepping on the gas. You should be pulling back a little bit and not betting your full capital size or your full position size. So the next step is volatility analysis. So here's the thing. Now you've created your watch list. You've analyzed the markets. You've analyzed the sectors. You now have a situation where you're essentially saying, okay, I know what my basket should look like. I now have entry points for the names that I'm interested in. Now the question is, now this is where the difference, I guess, between stock trading and option trading is really significant, because now what options markets allow you to do is have an extra gas pedal. That extra gas pedal is a little something called volatility. So obviously when you're picking a stock or an option, you want to go in the correct direction that you think the stock is going to go. But sometimes it accelerates faster than you think, or sometimes it doesn't. And that's where volatility comes in. Analyzing this is super important because it helps you determine, and here's where it is really, really important, guys. It helps you determine which option strategy to use. Another huge mistake new option traders make is that they just buy puts or they just buy calls. They don't do spread strategies. They don't understand the difference between a debit spread and a credit spread, and they don't know when to implement those strategies. This is where step 4 comes in. Volatility and strategy. You're going to be matching appropriate option strategies to the current volatility conditions. It prevents using strategies poorly. So when volatility is high, guess what's going to happen, guys? Your options are going to be super expensive. Whether you're going long or short, it won't matter. Volatility is high, your premiums are going to be high. That means that you have to come up with a strategy that allows for those higher premiums. You might want to consider being an option seller during those time periods. It ensures ability to enter and exit positions with minimal slippage, technical parameters, optimal volatility conditions for optimal option strategies. It prevents using high volatility strategies in a low volatility environment and vice versa. So what you want to do is buy long calls and long puts when volatility is cheap, when the VIX is low, when the volatility index is low or implied volatility is low. That is when you want to use the most aggressive option strategy possible, which is long calls and long puts. It's funny, the simplest option strategy is the most aggressive. That's another reason why new option traders sometimes aren't successful, is because they automatically go to straight calls and straight puts. And guess what? Those are the most aggressive strategies. When you put together a spread strategy, you're essentially picking specific targets, and you're allowing for time decay, and you're allowing for volatility to essentially be high in certain cases, where it kind of sucks that up a little bit. Price structure aligns position sizing with market conditions and volatility levels, prevents overexposure during high volatility periods. So again, when volatility is high, that means things are kind of bouncing around a lot, and you essentially want to come up with strategies that allow for you to sit through those ups and downs that you might get. I have a feeling that, with all the tariff stuff that's going on, for instance, we might see a lot of plus 1% days and a lot of negative 1% days. We're going to see a lot of bouncing around going on in the next couple of months, I would imagine. And you got to come up with strategies to be able to absorb that volatility. So step 4 is super important. You have to know what type of environment are you in, not just bullish or bearish, but are you in a low volatility environment? Are you in a moderate volatility environment, or are you in a high volatility environment? So essentially, it optimizes trade timing based on volatility patterns, maintains current volatility appropriate candidates. It prevents trading outdated setups in change volatility settings. So again, going back to your basket management, basket portfolio exposure to volatility, prevents concentration in just one single volatility regime. So ideally, you want to analyze volatility every single week. Now, volatility could come really fast. You could have a really low volatility environment. It's not like the sectors that sometimes weeks and weeks and weeks you could be in one favorable sector. Volatility comes fast, and it could come in a hurry. So you have to be kind of ready for that. So essentially, there's 4 fundamental strategies with options. For those of you that are listening that are brand new to options, the only main difference between trading stocks and trading options is essentially with stocks, you can either go long or you can go short. You can be bullish or you can be bearish. With options, you can go long and you can go short, but you can also be something called debit, or you can be something called credit. If you are an option buyer, no matter what strategy you're using, if you are an option buyer, if you're buying a call or a put, you are paying for it. So that makes you a debit buyer. Whenever you're taking something out of your pocket and you're paying for something, you're a debit trader, which means when you're paying for something, you want volatility to be low. When volatility is high, you should lean more towards being an option seller, where you are actually receiving that volatility and you're hoping it goes down while you're an option seller and while you're in that trade. So that is the main difference. Options give you the most choices, or the most options, no pun intended, but it allows you to be as versatile as possible, which is why I love it so much. Volatility alignment, you want to match appropriate strategies to volatility conditions. Lower VIX favor debits, and higher VIX favors credit trades. This is stuff that we all go through in our community, in the newsletter, and so on and so forth. We talk about the difference in strategy, and that is step 4.
John, do you have a level in the VIX that's considered high or low, or is it more it's trending? Or
well, you obviously want to look at 2 things. That's a great question, Pete. You want to look at the VIX, obviously, which is the chart you see in front of you. It looks kind of like an EKG monitor. It tends to like spike really fast and then drop. It spikes and it drops. So obviously, when it spikes, you want to be more of a seller and let it compress. When it's obviously a little bit complacent, that's when you want to be an option buyer. You want to be a debit trader, where you're buying calls and puts. So long story short, anything above 20 to 25 is considered pretty elevated. Anything a little over 18 or 16 is considered somewhat elevated. Complacent, I would say, would be under 14, anywhere from like 10 to 14, something like that. Just as a comparison, during COVID, the VIX, I think, got as high as in the 80s, just to kind of give people an idea of panic zone, you know what I mean? Or during the financial crisis, the VIX was also like around like in the 80s, 88 level or something like that. So yeah, it tends to spike and then come off a little bit. And in an environment like that, you want to be more of an option seller and change your strategy a little bit. But that's one component. The next component is the individual stock you're looking at. So you want to look at the implied volatility of the individual stock. So anything above 25%, 30% is somewhat elevated. When a stock's implied volatility is over 50%, you should seriously consider a multi-leg option strategy where you're not buying straight calls and puts. You want to be either more of a seller, or you definitely want to put together some sort of 2-leg strategy where you're a buyer and a seller at the same time. That actually helps you sell options, helps you receive that volatility, and it helps you offset the cost of the debit that you might pay. So without getting too into the weeds on strategy, volatility really helps you make those decisions. So, there's dozens of different option strategies out there that we're not going to have time to cover in this class. But basically, you have to look at it when you go to Home Depot and you have like 100 different. You go to buy a drill set, you have 100 different pieces. You're not always going to use all those 100 different pieces. There are basic strategies to learn, and you can kind of build on those as you get experience. You don't have to be worried about knowing every single one or being an expert in iron condors and butterflies and all that fancy stuff. Understand the basics, understand debit and credit, and that's really all you need to know to be a consistently profitable option trader. And then you can build that skill over time. So basically, debit trade selection is normal to elevated. So there's your answer, about 16 or so. Credit trading, you want to avoid credit spreads and low volatility, except for when individual stocks are unusually high. So like during earnings, when there's news, they tend to have spikes in implied volatility. Some stocks are just naturally high. Like an example would be Coinbase. Coinbase is always high. Tesla used to be always high. There's some names just have more volatility than others. And those you have to be acutely aware of when you're trading them, because you're always overpaying for those premiums. So that's step 4. And it's really important because it's something that separates a novice trader from a professional. You have your basket, you know what you want to buy. Step 4 tells you essentially how to buy it. What are you going to buy? How are you going to buy it? What strategy are you going to implement? And what time frame are you going to use? So finally, We're down to our last step, Pete, and everybody who's listening. We have our last step, which is basically placing the actual order. So you've done all the homework. You have your basket. You know how bullish or how bearish you want to be. You know exactly what sectors you should have been looking in. So you picked a watch list from the best of the best and the worst of the worst. You analyze volatility, and now you know what strategy you want to implement, and you place those orders. Now, essentially, what you have to do is do it the right way. So essentially, I have a little acronym here that I like to use. Again, not something that I invented, but some people say SET, some people say tests, but I think it's a really important acronym to memorize. You want to have an edge, number one, which we're going to talk about in a second, and then you're going to have a simple 5-step process for placing the actual trade. Pre-planned responses to different market scenarios eliminate emotions. Clear exit entry rules prevent impulsive changes. Volatility assessment, it helps you predetermine position sizing, and scaling plans improve capital management. It removes guesswork from trade execution. Strategy alignment, understanding edge before any for entry validates trade rationale, provides confidence to hold positions too. So risk management benefit to this, it views trades as a larger basket instead of just one individual name. Like I said, it gives you a portfolio perspective. Position sizing benefit, it's a preset scaling rules to optimize entry execution. So you have to have rules in place ahead of time where you know what your optimal position size, you know what a half position size looks like, and you know what a quarter position size looks like based on the size of your account. So this is all risk management. The first thing you want to do is assess your edge. So what the heck does edge mean anyway? It's a little subjective, but I have very specific rules when I look at an edge. What I want to do is I want to justify why did I pick this particular name out of the whole universe of 10,000 names that I could have chosen. Why did I pick this particular name at this particular time? What is my edge? So it's in a great sector. It's in an uptrend above both moving averages on heavy volume. It just recently pulled back into its moving average, so it's providing a fantastic entry point. Do you see how I'm slowly building a case to get into this particular trade as opposed to maybe 2 or 3 others that are on my watch list? I'm building a case for this particular trade. That's my edge. So that's my justification for entry. Once I determine that, I determine what my target should be. Now, sometimes you might have multiple targets, but you want to establish a specific target before you enter the trade. That is the key I want you guys to kind of take away from this. This should all be done before you start actually getting into the trade. You want to know what your target is ahead of time so you're not in a frantic panic and you're not managing and overthinking when you're actually in the trade. You want to establish price targets before entry based on technical analysis, including both primary and secondary targets to optimize exit planning. Your entry criteria should be defined as well. You should have conditions, including price levels, technical triggers, like I mentioned, bull pullbacks, bear rallies, that kind of thing, and scaling plans. Do you want to pile into it all at once and be super aggressive? Sometimes that's appropriate. Or if the market is giving you a B- and the market turns into an A+, you should be scaling into a name like that if it's doing well, right? Because you maybe didn't step on the gas on Monday, and now on Wednesday, all of a sudden the markets are ripping and you want to step on the gas a little bit. So these are things to consider during this time period. How are you going to enter this trade? Entry criteria. Stop loss rules is the S in tests. What is your ultimate stop? Now, I do a percentage-based premium. So let's say I pay $10 for my option. I generally set a percentage of premium as my maximum loss. It's a super easy way to quantify how much you're willing to lose for how much you're willing to make. So simply put, if I have a $10 option and I do a 40% maximum premium loss, at $6, I am getting out of that trade. That is my hard stop, end of story. So that is basically what I do. I do usually, I would say 80 to 90% of the time, I personally prefer a percentage of premium exit as a hard stop. Another stop loss rule would be, very importantly, is my edge gone? So another stop is, again, if I haven't reached my maximum stop, is my edge gone? Did the reason why I get in this trade, is it no longer there? Maybe the sector deteriorated. Maybe the market deteriorated. Maybe there was headline news. Maybe something happened to the stock that wasn't the case 3 days ago when I entered the trade. That's not me making a mistake, by the way. That's simply me adjusting for what happened, for new news. Our stocks in our portfolio and our basket is not in a bubble. It's not isolated. So we have to be very aware of what's going on around us and make any changes throughout the week that we see fit. So has my edge disappeared is a very important question you have to ask yourself when it comes to trade management. The time frame is the last T in tests. Calculate expected trade duration. How long do I think it's going to take for me to reach my target? That also helps me, by the way, matching my option expiration date. Obviously, you want to be conscious of time decay when you're trading options, which we talk about all the time as well. You want to try to allow your trade to work for as long as possible, and you want to pick the optimal expiration date to allow for that. So that's where the last T comes in. Time frame. How long do I plan on being in this thing? Position sizing. Again, that goes back to, are you scaling in, or are you going to pile in all at once and be more aggressive? That depends on step one. How aggressive is the overall market treating you, and how aggressive do you want to be for this particular situation? During the time that you're in the trade, you're going to be doing dynamic management, where you're going to be monitoring market conditions and sector strength and any changes in the basket. If there's a rotation, or if there's something that changes throughout that week, you might want to reduce a position. Just because something is underperforming doesn't mean you necessarily want to get out of the whole thing. It might just be a pullback, or it might be a sector rotation where it could be uglier, where you might get stopped out. In that case, you might want to consider exiting early. So again, it's all about dynamic management. But what you're essentially doing is you're not guessing. You already have a plan in place. You already know what you're looking at. You're looking at the markets, you're looking at the sectors, and then you're going to be looking at the individual stock chart to see if you maintain your edge. If you haven't maintained your edge, you should consider an early exit before your hard stop, or potentially scaling back on your position if the situation changes. So I hope that makes sense to everybody too. Let me know if you have any questions on that, because that's a very important concept. So that's pretty much the whole process from start to finish, guys. I hope this makes sense to you. I'm going to get into now a little bit about what we're offering today. The newsletter alerts and AI coaching is really what we want to show you, what we're offering you today. So I'm going to get into that now. Pete, feel free to add anything that I might miss, but I'm going to go ahead and talk a little bit about what we're offering for those of you who are watching this, and the promo that we are giving out today for those of you who are participating today in this webinar. The option basket promo code, by the way, write this down, as options webinar 225. We'll repeat it again shortly, but just kind of write that down so you can get the discounted rate that we're offering for you guys today.
The link in the promo code, John, is below the video in the description.
Oh, excellent. So in the video, so below in the description, you'll have everything you need to know as well. But if you want to take a look at that, definitely keep that promo code in mind. We want you guys, obviously, for participating, we want you guys to get the discounted rate. So bonus training and AI limited time offer. We're going to offer you the newsletter as well as some bonuses today, which we're going to show you. The Option Basket newsletter is something we put out. It's published 2 times weekly. We're going to offer you a 12-month access, where essentially what we're doing is we're delivering it by email, Discord, and a private member portal. Normally it's $9.95 for that 12-month access. We're going to be saving you $200 today with that promo code. So keep that in mind. In this newsletter, you can see on the right-hand side, I actually do all the work for you guys. I grade the market from one week to another. You can see where the sector strength is, where the sector weakness is, and we go over actionable trade ideas as well. So here's an example of the swing trade alerts as well as adjustments. As you can see on the left-hand side, you can see target, entry, stop, time frame, sizing, strategy. I'm giving you that test strategy. You can also see on the very top where I talk about the edge. So here's a real live example of where I'm talking about my edge. The stock has gone nowhere, trading in a range for a month and below both SMAs. Earnings are on the 13th, so this will be a smaller position to capture some of the volatility and time decay. So this is the kind of thing where I'm saying, we will look at the at-the-money straddle near earnings date to decide, if that 140 price is safe. So essentially, I'm putting together a bear call spread, which is that is a bearish strategy. I'm essentially saying that it's going to not reach that line that I drew there. So I'm kind of justifying why I'm doing it. I'm justifying why I'm picking it. And I wanted to add a more softer or bearish trade to my strategy. And I basically mentioned it there. I basically went through the whole process with you guys. So the option basket course, on top of the newsletter, on top of these actionable trade ideas that you'll get in the newsletter, you're going to get the option basket course, which will actually be a video with examples of what we talked about during this webinar, obviously, but in much more detail. A comprehensive video-based training modules, which you'll obviously have access to that 12-month period, step-by-step options trading tutorials, real-world examples and case studies, summaries of all lessons, and a self-paced learning format. So obviously everybody learns at different paces. So what we allow you guys to do is have the recordings where you could rewind and watch them over and over again, and you can see exactly areas where you might have questions or might be a little weak. You can watch them over and over again. So that's a home study option basket that we're offering you guys as well, in addition to the newsletter. On top of that, you get Pete and myself on Saturday mornings, which we have a lot of fun, by the way, Pete. I enjoy them personally. I think it's a great way to start off the weekend and kind of recap what we talked, what happened all week long. And it gives us a game plan basically for the week ahead, which I think is fantastic. I think it's a wonderful way to, it gives both of our perspectives on the markets, on what we're seeing, and actually what we have to kind of worry about ahead, whether there's economic news coming out, whether there's earnings, whether there's anything that could potentially change markets. We talk about it, live on Saturday mornings.
We've had members say that the Saturday sessions are one of the most valuable parts of the membership.
I find them super valuable because it makes me do my process step by step, and then you go over how you look at things, and I would say we're in agreement a lot of times, but we talk a lot about strategy, which is super important from a high level perspective, where we look at the overall markets, we look at the overall sectors, just like I mentioned in this 5-step process, and we essentially come up with what we think is going to happen for the week. Obviously, we make adjustments during the week and we make our changes, but we have a solid game plan for the week ahead. And I think it's super invaluable especially for a brand new trader who needs a little bit of guidance as to what to look at and how important certain things are. There's so much information out there. Sometimes it could be like an information overload. I know I've heard that before. People feel overwhelmed because there's too much information out there sometimes. And what I love about our game plan meetings is that it kind of simplifies it in a step-by-step game plan process, which is great.
Yep. I just want to recap that just a little bit, John, just so everybody's super clear, because there's some new members that are messaging me right now. The newsletter is you doing all of the 5 steps for everybody. So I want to be clear about that. You're doing all of the work, and then at the very bottom of that, you're putting trade alerts in there, ideas based on following those 5 steps. Then the course itself teaches you or improves upon what's taught in the newsletter, so you can actually use the newsletter. I think that's one of the biggest differences. Is it's one thing to have a course. This course is specifically designed to capitalize on the newsletter, which is that's the whole point. We want you to be able to implement it with conviction. And then the Saturday sessions allow you to ask us questions about what happened during the week. So it's kind of a really nice cycle of market analysis, alerts, newsletter, trade, come and ask questions. I think that feedback on Saturdays is a really important part of it.
Absolutely. So the newsletter kind of shows you everything, but obviously if you're new to this, and you could be, it could be a little overwhelming to kind of, what do I do with this? Right. So we give you actionable trades in the newsletter. We show you what's going on. The courses are designed to kind of break that down and, in digestible pieces where you could go back and and review everything. And then the live sessions are on Saturday, where we actually break everything down in real time. We talk about current, what's going on currently. So it is a great cycle. It's a great way to learn this process from start to finish, for sure.
So if anyone wants to learn more, obviously the link is in the description below the video.
Absolutely. So we have another bonus, and this is really exciting. This is brand new, actually, which is really exciting. Bonus number 2 is coaching AI. So let's say, you obviously have a lot of videos, you have the videos to go through and so on and so forth. But let's say there's a topic that you're a little bit unsure of, or, there might be one part of the course you forgot what part of the video it was on. We have Coaching AI, which is a built-in expert at prompts. It helps you ask the right questions to get the most valuable answers. So new traders can follow guided learning paths, while experienced traders can do a deep dive in specific strategies. So maybe you kind of know certain things about options. Maybe you've read a lot of books and you kind of know what definitions are and stuff like that, but there might be 1 or 2 things you're unsure of. The AI allows you to type in specifically what you need to learn, and it'll give you obviously a worded definition of what you're specifically looking at. Or if you're brand new and there's a term or something you didn't quite understand, and you don't want to spend a whole hour trying to dig through it, what's really great about the Coaching AI is it eliminates that whole process. It just zeroes into what you're specifically asking. So that is the second bonus that we're offering to you guys tonight, which I think is fantastic. I wish I had this 20 years ago when I was reading all my books. This would have saved a heck of a lot of time. But obviously, this assesses the trading wisdom 24/7 right when you need it. So it's a fantastic way to kind of reinforce what you've learned and everything else. So this usually that has a value of about $1,295. Plus 2 more bonus reports. We're going to give you, I want to talk really quickly about what a poor man's covered call is. It's a fantastic strategy, which I'm going to get into in a second. And we'll talk about the Option Trader's Black Book, Secrets to Market Mastery. So these are 2 bonus reports that we're going to give you, along with the newsletter, along with the Saturday morning access, along with the process, the video education as well. So the bonus report 1, this implement option trades with confidence, knowing exactly how to structure your options portfolio for any market conditions. You'll see the markets with new clarity as you learn to spot institutional order flow, anticipate rotations, and build a balanced basket. So it'll also help you apply the right strategy with examples and so on and so forth. So it's a great bonus report you will receive as well. And this one too, this is a powerful strategy. So for those of you who can't afford 100 shares of something, there's something called the Poor Man's Covered Call, which I use all the time. It's a great way to generate consistent income without having to buy necessarily 100 shares of stock and selling covered calls against your position. Without getting into the detail of it, it's a way to put together an option strategy that allows you to benefit from covered calls without having such a large account size. It allows you to diversify as well, which is super important. So with clear guidelines of strike selection, risk management, and trade exit rules, you can execute this strategy with confidence. So there are right ways to execute this strategy, and there are very, very, very wrong ways to execute this strategy. And I go over in this report exactly what the right methods are to use, as opposed to what some of the mistakes a typical new trader might make. So that's a really invaluable report. Poor man's covered calls. So one-on-one onboarding session. So this serves as your personal guide to maximize the program's benefits. It'll identify which parts of the membership will be the most impactful for you individually. So Pete, do you want to talk a little bit about this? Because this is a really important part about the whole thing. It gives you more one-on-one. This is the real one-on-one session that you'll get, which I think is super important.
Yeah, I think this is something that makes what we do very different. We actually want you to use what you're investing in. So we spend a lot of time gathering your experience, where you are, what you've tried, so that we could match where you might be struggling right now, or what you've tried before that's not working, with the right part of the program, whether it's the newsletter going straight to the alerts, whether it's the course, the AI, and make sure that you're actually using it. I mean, I'm sure everybody who's watching this or listening to this right now, you probably downloaded 1 billion ETFs. You probably graduated from YouTube University, and you keep getting more and more and more training, but you're not actually implementing it and being profitable. So the onboarding sessions are designed to let you know how much we care about you actually using your investments so that you can get the ROI over the next 12 months. It's a really important part of the program.
Yeah, it's super important. It allows you to kind of, communicate with us. What are some of your personal roadblocks and how we can help you. And that's really what it's all about. So this is super important part.
And those are Zoom calls as well, because we want to show you the member portal as well. We want to log in with you, screen sharing to show you where everything is. If we tell you there's AI, you want to be able to find the AI. If we tell you there's a course, you want to be able to access the course. If we tell you there's a newsletter, we want to show you where it is so that you're actually using it. We care about you getting the ROI. It's not just about signing up.
Absolutely. So super important part of that. It helps you find, it helps you really find where everything is and helps you maximize the program as much as you possibly can. So the promo code again is Options Webinar 225. It's going to be on the bottom on the link as well. The Options Basket newsletter retails at $9.95 on its own. If you look at this entire value, it's $5,400 if you add up all the stuff that we're offering this in total. Between the option basket cost, the swing trade alerts and adjustments, the Saturday swing trade sessions alone, like you said, Pete, our community members alone say that those Saturday sessions alone are huge value, just because of the fact that we go over every single thing that's happening in real time and what's going to happen for the week ahead. So it gives you an actual game plan to move forward. The options trader black book, as well as the poor man's covered call strategy, all this value totals about $5,400 if you kind of do it a la carte and put it together piece by piece. Through Sunday, 12/23, we're going to offer this out at $795 with that promo code.
223.
223. What did I say? Did I say 323?
12.
Oh, 12. I'm thinking of Christmas already. Yeah, my brain is a little fried today. Sorry about that. But yes, 223.25. Say that 3 times fast. $795 in total with the promo code, and it will expire obviously on Sunday. So please act if you want to participate. We obviously really enjoyed having you guys here, and we essentially have put together this community piece by piece. And we really enjoy doing this. I know I could probably speak a little for Pete. This is one of the most rewarding things I've done throughout my career, is not just trading on my own and trading my own account and stuff like that, but being able to kind of take my experience and share it with you, and be able to show you a step-by-step process that is actionable, that is followable every single week. Is something that I don't think anybody really offers. It's just something, people talk about trade ideas or alerts, or you sign up for 1 or 2 ideas. We really break down the markets in a digestible way that makes sense every single week.
So the link to learn more is in the description below the video. But John, let's just wrap up with what makes this different from the way that most people who struggle trading options tackle the market. What makes this different?
I say the main difference is what I said earlier, is that your trade is not in a bubble or a vacuum. You're not looking at individual names. You're not picking, I know a lot of people only trade the same stuff every week. They might only look at 10 things. What we do is we essentially have an unbiased approach where we let the markets tell us what we should be looking at, not the other way around. It eliminates the emotion, it eliminates bias, and it essentially allows us to find the best of the best. And if you want to go short, obviously, the worst of the worst on a weekly basis. And it allows you to be consistent. You're not going to necessarily, once in a while, you might get a home run, but this allows for consistency. And I think that's the key too. I think especially with options, because of the implied leverage that you have, obviously, a lot of traders, they'll put all their eggs in one basket, no pun intended, and they'll lose it all because they're essentially relying on one big home run as opposed to building out a basket every single week. It does take a little bit of practice. It takes a little bit of knowledge, but what I like about it and what makes it different is it's a repeatable process. It's not something that's really going to change from week to week. The names will change, but the process does not change. And you'll get better at it every single week.
All right, let's wrap it up. We'll have obviously the video be available for everybody to rewatch again. Thank you, John, obviously for tonight. Thank you, everybody who attended and is watching on the replay. The link to learn more, click through and learn and see everything that's in the program. Make a decision if it's the right investment for you for the next 12 months. And we'd love to see you on the Saturday calls coming up.
Absolutely. I'm looking forward to seeing each and every one of you, and please enjoy the rest of your night. And I hope this was helpful. And again, we're always here for you if you need us.
Thank you, everybody. Have a great day.
Have a good night, everybody.
Bye-bye.